Previously, in the previous lecture, we started our discussion with an important topic titled Variance Analysis. And before starting with that topic, we introduced some of the concepts that needs to be considered and needs to be understood in order to understand what do we mean by variance analysis. And of course, we started our discussion by introducing the concept of budgets and what do we mean by budgets, what are the importance of budgets, and what are the different phases within any budget cycle. And then we started our discussion with our title, Variance Analysis. We defined what do we mean by a variance, and we said we cannot calculate or determine any variance without having the budget. Therefore, we need to have a budget in order to calculate the variance. And we said the variance is the difference between the actual and the budgeted amount. And then we started with our example of web company. Of course, the time wasn't enough the last time to complete this example. Today we are going to complete the web company example. Of course, web company, as we said the last time, it produces jackets. Of course, this company only incurs manufacturing costs. Of course, this assumption is only to make this example more simple for us in order to understand what we mean by the variance analysis. Therefore, this is an assumption. We are going to relax these assumptions when we are going to go through some of the problems at the end of this chapter. Of course, it only incurs manufacturing costs. Therefore, it does not incur any administrative, any let us say distribution, any selling expenses. Also, another assumption which would make this example more easier even, or easier, is that the same units that is manufactured within April 2011 would be sold in April 2011. And this assumption means that we are not going to have any beginning or ending work in process inventory. We are not going to have any beginning or ending finished goods inventory. And we are not going to have any beginning or ending raw materials inventory. Therefore, this assumption would make this example more will make it easier for us to understand. And then, according to the example itself also, the example states that the web company has the following variable expenses, has direct material costs by the amount of $60 per jacket, has direct manufacturing labor costs by the amount of $16 per jacket, and variable manufacturing overhead costs by the amount of $12 per jacket, therefore a total of $88 per jacket as variable costs. And of course, we stopped right here the last time. Now let us continue with the web company. Of course, the example also states that the number of units manufactured is the cost driver for direct materials, direct manufacturing labor, and variable manufacturing overhead. What does this mean? That means that any change in the number of units manufactured would affect a change in the total variable expenses, not the variable expenses per unit. Therefore, the 60, the 16, and the 12 would not change, but the total variable expenses would change as the number of units manufactured changes. Also, it states that the relevant range for the cost driver is from 0 to 12,000 jackets. Of course, what do we mean by this information, or by the definition of the relevant range? Here it states that the relevant range is only from 0 to 12,000. That means excellent. Therefore, the relationship between the cost and the cost driver only stands or is applicable only within this relevant range. Outside this relevant range, we might have some differences on the variable expenses and the fixed expenses. Of course, the example also states that the budgeted and actual data for April 2011 are as follows. Budgeted fixed costs for production between 0 and 12,000 jackets is $276,000. This is the fixed manufacturing overhead costs. Budgeted selling price, $120 per jacket. Budgeted production and sales, because we said, according to our assumption, that the same number of units produced would be sold. Therefore, the budgeted production and sales, in number of units, of course, is 12,000 jackets, while as the actual production and sales was 10,000 jackets. Now, as you can see, we have the information, we have our information about the actual and about the budgeted. Therefore, we can now compare the two, compare the budgeted amounts and compare the actual amounts. And by this comparison, we can calculate our variances. Let us see how we are going to present our analysis. But before discussing this presentation of the variances, we need to consider that the variance analysis is classified into different levels. It starts from level 0 and then level 1 and then level 2 and ends in level 3. Of course, in chapter number 4, we are going to take the 4 variance analysis. That would be in the following chapter. But for now, we need to know that any variance could be classified into these different levels. Of course, as we go up in the numbers or we go up in the levels, the degree of details increases. This means that the level 0 has the lowest amount of details, while as level 3 has the highest amount of details. And of course, level 1 has more details than level 0, level 2 has more details than level 1 and 2, and level 3, of course, as we said, has the highest amount of details. Therefore, now let us go back to our example and see how we are going to present the information, how we are going to present the variance analysis. As we can see here, there is a column for actual results and another column for the budget. And of course, the differences between the first column and the third column is the variances, as we can see here. Therefore, we had revenues by the and actual results revenues by the amount of $1,250,000, while as according to our budget we have only $1,440,000 according to our budget. Of course, now the expenses or the costs. We start with the variable costs, of course. Direct materials, the actual number or the actual amount is $621,600, while as according to the budget it is $720. Therefore, there is a difference by the amount of $98,400. The direct manufacturing labor actual cost is $198, while as according to the budget it is only $192. Therefore, we have a variance by the amount of $6,000. It is only a comparison. We are only comparing the two numbers. We are only subtracting the two numbers in order to know if we have any variances. This is the calculation of any variance. Then the variable manufacturing overhead, $130,500, while as the budgeted $144. Therefore, $13,500 is the variance. And then the fixed cost 285 actual amount, while as the budgeted, as we saw, or as the example stated, was $276,000. Therefore, according to the operating income here, we have the operating income according to our budget 108,000, while as according to the actual results we have only an operating income by the amount of 14,900 with a 93,100 variance. First of all, as we can see here, we have different notations. We have the U and we have the F. Excellent. The U stands for unfavorable variance, while as the F stands for a favorable variance. So, what do we mean by a favorable variance? And what do we mean by an unfavorable variance? What do you think? From the term itself, favorable and unfavorable. Favorable, the actual more than the budget. We cannot say that because here we are comparing two different things. We are comparing revenues and we are comparing costs. So we cannot say that the actual is greater than or the favorable variances is because the actual is greater than the budgeted, or the budgeted is greater than the actual. We need more details in our definition.
In revenue, favorable stand for the budgeted is more than the actual. And in the expense or cost, favorable stand for the actual is more than the budgeted.
No, the opposite. The opposite. In let us take a general definition of favorable and unfavorable and then go to the details. First of all, favorable variances are variances that affect net operating income or affect an increase in net operating income. Therefore, any favorable variance would increase the operating income. Again, the favorable variances are variances that affect an increase in operating income or net operating income. While as of course the unfavorable is the quite opposite. Unfavorable variances are variances that affect a decrease or affect a decrease in net operating income. Therefore, according to the revenues, the variance would be favorable if the actual is more than the budgeted. If the actual revenue is more than the budgeted revenue, the variance would be favorable, because as we can see, if the revenue would increase from the budgeted, that means this increase or this variance would affect an increase on our net operating income. Correct? While as the opposite, if the actual revenues are less than the budgeted revenues, we would have an unfavorable variance. Because as we can see, if the actual revenue was less than the budgeted revenue, that means the net operating income would decrease in relatively to the budgeted net operating income. Therefore, as we can see here, according to the revenues, the static budget or the budgeted amount of revenues was $1,440,000, while as the actual was $1,250,000. This means, of course, the difference between the two is $190,000. But is it unfavorable or favorable? It is unfavorable. Why? Because the actual is less than the budgeted. While as, for instance, for the direct materials, let us take the direct materials as an example. The actual cost is $621,600, while as the budgeted cost was $720,000. Therefore, the cost here is less than the cost here. The actual cost here is less than the budgeted cost here. Therefore, this would affect an increase on our net operating income. Hence, the favorable notation. While as if we have it on the other way around, for instance, the direct manufacturing labor. As we can see, the actual number is $198,000, while as the actual amount is $198,000, while as the budgeted amount is $192,000. Therefore, the budgeted is less than the actual. That means that the actual is more than the budgeted. Therefore, we have an unfavorable variance. Why? Because this variance would decrease our net operating income because it increased our costs from the budgeted amount. Any questions? Therefore, favorable variances are the variances that affect an increase in net operating income in comparison to the budgeted net operating income, of course, while as the unfavorable variance is a variance that affects a decrease in net operating income in comparison to the net operating income or the budgeted net operating income. Any questions? Now, as we can see here, that this variance analysis or level 1 analysis gave us the different variances for each item of the revenues and costs in the income statement. As we can see here, this is the income statement. Revenues minus variable cost would equal the contribution margin. The contribution margin minus fixed cost would equal operating income. This is the income statement. And level 1 analysis would compare each item within the income statement in order to get the variances and, of course, determine if these variances are unfavorable or favorable. This is the level 1 analysis. Now, as our analysis shows that we have an operating net income variance by the amount of $93,100. Now, consider yourself a cost analyst or a cost accountant in an organization, or a management accountant in an organization. And the manager comes up to you and says, I made this analysis, this simple analysis between the budgeted income statement and the actual income statement. And I came up with a variance by the amount of $93,100 unfavorable variance. So, you, as a cost analyst or as a cost accountant or as a management accountant, I need you to give me the causes, give me the reasons of this variance. So what do you think are the causes or reasons of this variance? The 93,100 unfavorable variance. Why do we have this variance? Because of what exactly? It could be excellent. It could be that in preparing our budget, we didn't consider all the conditions. We didn't consider all the economic conditions, we didn't consider some of the market conditions, and so on. Therefore, we had missing information in predicting our future. Therefore, we might have some problems in predicting the future or preparing our budget. Could be.
The production and sales didn't match.
Between what and what?
Budgeted and actual.
Excellent. As we can see here, the budgeted amount is considered or was prepared according to 12,000 units or 12,000 jackets, as we can see here. Therefore, this revenue is according to 12,000 jackets. These costs are according to 12,000 jackets. While as, according to the actual results, the actual number of units produced and sold was not 12,000 units, but 10,000 units. Therefore, the revenues here is according to the 10,000. The costs here, whether variable or fixed, is according to the 10,000. Therefore, this is the cause number one of this variance. Cause one, different actual units sold, of course produced and sold, than budgeted. This is the main, or this is one of the reasons that we have this 93,100. But is it the only reason that we have this variance? What is the other reason, or other reasons if you have more? Go ahead. Excellent, excellent. Therefore, we also might have different selling prices and different costs per unit. Let us take the example here. 1,440,000 divided by 12,000 would give us the amount of $120 as the budgeted price, selling price. While as here, 1,250,000 divided by 10,000 would give us a $125 as the selling price. It is not only the reason this $190,000 as a variance or unfavorable variance was not only because the difference between the 12,000 units and the 10,000 units, it is also because of the difference between the selling price in the budgeted or in the budget and in the actual results. We cannot say.
We sell at a higher cost, higher price. So this minimizes the variance between the actual and the budget.
Higher price means we have higher cost.
And you mean that if we have a higher price, therefore this variance is good?
No, it's not good. Higher price means higher revenue in the actual.
Yes.
And this minimizes the difference between the actual and the budgeted revenue.
In order to say that, or in order to analyze or to get to this analysis, we need to divide this 93,100 to the different causes before analyzing it into the different, let us say, scenarios or the reasons.
We have to look at the cost.
Of course, we are just now talking about the revenues. Now we are going to talk about the cost. Therefore, reason number one, we have this variance by the amount of 93,100 unfavorable variance. Reason number one, first of all, the number of units that was used or built upon in the preparation of the budget was different than the actual number of units that were actually sold. This is cause number one. Therefore, as we can see here, if we are going to multiply $120 multiplied by 12,000, it would be different than multiplying by 120 and 10,000. This would be 1,440,000, while as here it would be 1,200,000. Therefore, we would have a variance, we would have a difference because the change in the number of units sold. This is cause number one. Cause number two, the selling price and the different costs per unit may be or may differ from the budgeted and the actual, as we just saw here. As we can see here, as the example stated, that the selling price or the budgeted selling price was $120 per unit, correct? Now, according to the actual results, it was not $120. It was $125. Therefore, this $190,000 of unfavorable variance is because of two reasons. Reason number one, different number of units produced and sold. Reason number two, we have a different selling price from, of course, the actual selling price than the static budget or the budget itself. Like what?
Like the direct manufacturing labor, the hours.
These two reasons will apply to the revenues as well to the costs. Let us see, for example, the direct materials. The direct materials here, according to the budget, is $720,000. Therefore, the direct materials cost per unit is $60, correct? It is $60 according to the example. Look at your books. According to the example they gave us, that the direct materials cost according or per unit is $60. Now, here, 621,600 divided by 10,000, it would be $62.16. Is there a difference in the cost per unit? There is a difference. And also, there is a difference in the number of units. Here, we multiplied the 60 multiplied by the 12,000 units, while as here we multiplied the $62.16 by the 10,000. Therefore, we have two reasons that we have this 98,400 favorable variance. This variance is because we have different number of units sold and produced, and also this variance is because that we have a different cost per unit or direct material cost per unit than budgeted. Correct? And also, let us go to the direct manufacturing labor. The direct manufacturing labor is according to $16, as stated in our example. But here, as we can see, 198,000 divided by 10,000, therefore $19.8. As we can see here, also this variance is because of two reasons. The first reason is that here the 192,000 was calculated according to the multiplication of the $16 per unit multiplied by 12,000 units. Therefore, this is one of the reasons that we have this variance, is that we have the difference between the number of units that were budgeted and the actual number of units that has been sold. Also, the other difference is that the cost per unit also changed. Not only the number of units, but also the cost per unit or the cost per jacket. Therefore, here, as stated, it is $16. Here, according to what we calculated, it is 19.8. Therefore, this 6,000 unfavorable variance is because of these two reasons. The same thing for the variable manufacturing overhead. The 144,000 was calculated according to 12,000 units and according to a cost per unit by the amount of $12 as stated in our example. While as the actual results shows that the actual cost was, per unit of course, was $13.05. Therefore, we have 13,500 favorable variance because number one, we have different number of units, or we calculated our numbers according to different number of units. Second, we have different costs per unit. Now, let us go to the fixed cost. As we can see here, fixed cost according to the actual, $285,000, while as according to the static budget, it is $276,000. Therefore, we have a variance by the amount of 9,000 unfavorable variance. Now, why do we have this variance? Is it because, let us make it simpler for you to understand. Is this variance or the fixed costs unfavorable variance by the amount of $9,000, is it because the change in the number of units? Why no?
Because it's fixed cost.
So,
Doesn't affect.
excellent. We said, according to the example, the relevant range for this organization is from 0 to 12,000 units, 12,000 jackets. That means if we are within this relevant range, according to the definition of fixed cost, fixed cost would remain unchanged, would not increase and would not decrease according to the increase and decrease in the number of units. If, of course, we are talking about the relevant range between the 0 and the 12,000. And as we can see here, the 10,000 is within the relevant range. Correct? Therefore, this variance by the amount of 9,000 unfavorable variance is not because the change in these numbers or the change in the number of units sold and produced. Any questions? Any questions? Because this is the basics. This is the base upon which we are going to build our further analysis. We are still in level 1 analysis. Now, as we can see here, the 93,100 unfavorable operating income variance is because of two causes, as we said. Cause number 2, difference between actual and budgeted selling price and cost per unit. Now, the manager, after of course you told him that this 93,100 unfavorable variance is or might be because of two reasons. The first reason is the difference in the budgeted number of units and the actual number of units, and the second reason is the difference between the selling price and the cost per unit, of course budgeted and actual. Now he wants to know exactly what is the amount that is related to cause number 1 and what is the amount that is related to cause number 2 in order to make in order to evaluate the performance, in order to take correction or corrective steps, in order to take controlling decisions and so on. Therefore, he needs to know the 93,100 unfavorable net operating income is because of exactly what? Therefore, we need to divide this amount onto the two different reasons. Reason number 1 and reason number 2. Now, how can we do this? How can we divide this amount onto the two reasons that were just discussed? By introducing a new term called flexible budgets. So, what do we mean by flexible budgets? But before knowing what is the definition of flexible budgets, we need to understand what do we mean by a static budget. Of course, here the term budget and here the term budget, it gives us a hint that these two are according to budgeted selling prices and budgeted costs. Correct? As we said in our earlier discussion or in the previous lecture, that a budget is a quantitative expression of a plan of, or a proposed plan of action. Therefore, it is a determination or it is an expectation. Therefore, the static budget and the flexible budget both are concerned with future selling prices, with future costs, whether it is variable and fixed. So what is the difference between a static budget and a flexible budget? First of all, the static budget is concerned with only one level of output. As you can see here, we performed our budget, we prepared our budget according to our expectation that we are going to produce and sell 12,000 units. Correct? And we are not going to change this assumption. We are not going to change this prediction. And as we can see here, we did prepare and we did build up our budget according to the expectation or according to the prediction of 12,000 units to be sold and produced and sold. Now, the flexible budget, on the other hand, is a budget. The same as the static budget is concerned with future costs, is concerned with future or predicted selling prices, but according to an actual level of output. Therefore, the static budget here was built upon the expectation of 12,000 units, an expectation. While as here, the preparation of the flexible budget would be according to the actual level of output of 10,000 units. This is the difference, or this is the first difference between flexible budgets and static budgets. Therefore, when do you think a flexible budget is prepared?
After the actual result.
Excellent. That means at the end of the accounting period. Therefore, this is the second difference between the flexible budgets and static budgets, is that static budgets are prepared before the beginning of the year or the accounting year or the accounting fiscal year. While as flexible budgets are prepared after the end of the fiscal year or the accounting year. Because we do not know or we cannot know the actual number of units sold or the actual number of units produced and sold unless we have finished the accounting period, unless we have prepared our results according to what has happened actually in that period. Correct? Therefore, difference number one between the two. The static budget is built upon a prediction of number of units or an expectation of the number of units, while as the flexible budgets are prepared according to the actual level of output. Difference number one. Difference number two is that the static budget is prepared before the beginning of the year or the fiscal year, while as the flexible budget is prepared after the end of the fiscal year or the accounting year. So, two differences. What is the similarity here between the static budget and the flexible budget? Both are built upon budgeted costs and selling prices. Therefore, in our preparation of the static budget, as we can see here, we used $120, which is an expectation, which is a budgeted amount. We used the $60, which is a budgeted amount or budgeted cost per unit. $16, a budgeted amount or an expectation or a prediction. $12, a prediction. $276, a prediction. These amounts will be the same amounts or budgeted amounts or predicted amounts that would be used in the flexible budget. The only difference here, it will be built upon the 12,000, while as here it will be built upon the 10,000 units. Because as we can see here from the terms, both are budgets. Any questions? So let us see now the 93,100 unfavorable net operating variance and how can we use the flexible budget in order to divide this amount onto the two different causes for this variance. Yes?
In the flexible budget, we wait till the end of the fiscal year.
Yes, yes.
What's the point of having it? We could have...
Excellent, excellent. Therefore, we are not going to use the flexible budget for, let us say, our planning decisions. We use the static budget for our planning decisions. We only use the flexible budgets in order to have our corrective steps or in order to have our controlling decisions. Therefore, we need the flexible budget in order to understand why do we have this variance. Now, if I'm going to ask you now, the 93,100 unfavorable static budget variance. Of course, this is called a static budget variance because the static budget variance is the variance according to the comparison between a static budget and an actual result. Now, if I'm going to ask you, as a manager, for instance, I'm going to ask you as accountants now, or cost accountants, the 93,100 unfavorable variance is because of what exactly? As a manager, I need to make corrective steps. We have this huge number of unfavorable variance. I need to make decisions. I need to make corrective actions. I need to have control over this variance. I need to understand what was the problem in order to correct this problem. Now, as accountants, I'm asking you, the 93,100 unfavorable variance is because of what exactly? We cannot exactly pinpoint unless we find a way to divide this 93,000 or analyze this 93,100 unfavorable onto the two different causes that we have. That's why we need to use the flexible budget.
We can't do flexible budget unless we have a static budget.
Of course. Yani, the first thing we need to do is the preparation of a static budget. And then the flexible budget would be prepared at the end of the period. Of course, if we need to, if we have this big variance, and most of the times we need to, because most of the times we would have variances like this. The next time we are going, inshallah, to see how we are going to use the flexible budget in order to further analyze the 93,100 unfavorable variance. Thank you for listening, and we will meet, inshallah, the next time.